All right, how's it going, everybody? My name's Antonio, and I am on the barbecue today with Richard Young, the CEO of Argonaut Gold, a gold producer with 3 producing mines in Mexico and 1 in the US and 1 in Canada. Who's not here with us today, though, is your financial advisor. This conversation is not going to include any recommendations to buy or sell anything. Instead, it will be a general, impersonal, and just a casual talk between 2 people on the internet. And if your mom didn't tell you, you're not supposed to blindly trust strangers on the internet. You cannot use this conversation as independent research because it's also going to include forward-looking statements about uncertain events that may or may not happen in the future. So please take the minute to pause the video right now and read the full warning that is on your screen, because the mineral exploration, development, and mining industries are among the highest risk industries out there. So you need to be careful. Also, please visit setterplus.ca for the company's official filings, analyze them, and also consult a professional investment advisor before taking your own decision in the end. That all said, Argonaut is it's listed on the TSX under the ticker symbol AR, first of all. And there's also about 3 million shares that trade each day on average, with a market cap of about 350 million Canadian dollars and about 865 million shares outstanding. This is a 40-cent stock with a 52-week high of 77 cents and a 52-week low of 37 cents. About 43% of the shares outstanding are in the hands of 3 institutions. One of the most known ones of which, at least to listeners of this show, might be Franco-Nevada. And at the end of the third quarter this year, the company had about $45 million in cash, about $16.5 million in account receivables, and almost $110 million worth of inventories, for a total value of its current assets coming in at $188.7 million. Which, again, at the end of September, stood against a $195.6 million of current liabilities, made up mostly of account payables, debt payment, lease liabilities, and a portion of deferred revenue as well. The debt that I'm talking about here, by the way, is a term loan where about $200 million is still outstanding. And next to that, there's also a revolving credit facility with $30 million outstanding and a $20 million sum that is still undrawn. There is also a 4.75% convertible debt note with a conversion price of $2.86. And again, the current stock price is around 40 cents. So that's something for up in the future. Now, since then, actually this Monday, Argonaut has announced an $80 million bought deal, offering about 210 million shares at 38 cents, per share, with a 6% option issued to the underwriters, allowing for a potential $5 million more in financing, basically. As I said at the beginning, this is a gold producing company, so they already have revenues, and those came in at almost $105 million for the third quarter of this year, adding up to over $256 million year to date at the end of the quarter. That production now comes partly from their Mexican assets, of course. So that's specifically the La Colorada mine, the El Castillo mine, and the San Agustin mine. Those are open pit mines. They're respectively based. So one of them is in Sonora, and 2 of those are in Durango, Mexico. The goal, though, as far as I understand it, is to make production North America focused rather soon by doing 2 things. Number one, ramping up production and expanding the life of mine at their Florida Canyon mine. This is, it's funnily enough not in Florida, but it's in Nevada. And it's a 100% owned open pit heap leach operation with a 7-year mine life on it. So that's one. And then number 2, they also want to ramp up the Magino mine, which actually just started producing it. They announced commercial production about a month ago, if I'm not mistaken. This one is located in Ontario. It's close to the northeastern shores of Lake Superior. And this is a 100% owned operation as well. It's a conventional CIP mill open pit asset with a very long life of mine spanning up into the 2040s, and a 10,000 tons, that's a lot of T's for me, per day capacity on the mill itself. And with those 5 mines, Argonaut hopes to reach up to 165,000 ounces of gold equivalent production for the operation of 2023. And although I understand that to be the focus so far, that's not everything. And there is a development stage asset in Guanajuato, that'd be southern Mexico, where the company sees the potential for another open pit heap leachable mine to be brought into production potentially sometime down the road. And then even further back on the Lausanne curve, the company has 2 early-stage exploration assets in Canada that I'm hoping Richard will touch upon later on in the conversation. But that probably means that it's time for me to shut up and let this become an actual conversation already. So, Richard, thank you for investing your time in me, sir.
Well, thank you. That was a great summary. One point to note is that 165,000 ounces, that was from our existing operations, including Mexico and Florida Canyon. Then when you combine that with initial production from Magino, we would expect production at the bottom end of our production guidance range for the year of 200 to 230,000 gold equivalent ounces. But that was a great summary. Thank you for that.
Well, thank you. And the pleasure is, of course, mutual. I did, I try to sort of give a quick 5-minute summary to companies that I'm interviewing, but sort of hoping to do a 5-minute overview of a company with 5 mines is almost setting myself up for failure. So what else? What am I maybe missing, or something else that I'm getting wrong behind the 165 to 230,000 ounces prediction? What else?
Yeah, you've got it right. So from a nuance perspective, Mexico has been the cornerstone of this company in terms of production and cash flows since its IPO more than a decade ago. But for the first time this year, production from our Nevada and Ontario assets collectively will be higher than Mexico. The Mexican operations are older, more mature assets, require some additional capital. And when we look at our company as we move forward, as you highlighted, we're just bringing forward into production our Magino mine in Ontario. And we think that that has the potential to be one of the largest, lowest cost, and longest life mines. But it will require some capital. And we also believe that Florida Canyon has the potential both to extend its current oxide heap leach production, as well as look at developing the sulfides system that sits below that. So because of that, when you look at our company and the allocation of capital, the return on capital is much higher in Ontario with Magino and Nevada with Florida Canyon than it is with Mexico. So we are looking for ways to optimize the value of Mexico for our current shareholders, but more importantly, extend those mine lives for the benefit of our Mexican employee base.
I hope we can touch upon these assets as we move forward. But I obviously want to talk about the Magino mine here, which seems to be becoming your focus, as you said. Let's maybe start off with something topical around the bought deal financing from this Monday, I believe. And help me understand that financing better here, Richard, because in the news release, you say that it'll be used for the development and optimization of the Magino and Florida Canyon mines. But how come? I thought they were fully financed and ready to be ramped up to nameplate capacity as is. So what exactly do you need the money for?
That's correct. So yes, Magino is fully financed, and it has moved from construction into operation this year. And as you mentioned earlier, commercial construction was announced on November the 1st. So the proceeds of this financing, though, are not for the existing operations. They're for the growth, organic growth that we see within the asset base. So when you look at Magino, we've got 2.4 million ounces in reserves today. We've got a resource base within that Magino pit of over 5 million ounces in the various categories. So we raised money earlier this year to begin a program to convert resources to reserves within that pit. So some of the funds that we're raising this week will continue with that program. And we believe ultimately we can convert about 2 million of the 3 million ounces of gold that sit within that pit outside of the current reserve envelope. And with that, then we have the opportunity not only to optimize the current plant, as you mentioned, 10,000 tons per day, but also look at expansion. And we believe that there's an opportunity to increase throughput from 10,000 tons per day to something between 17.5 and 20,000 tons per day. And that would take production to 200 to 250,000 ounces per year. And we believe that we can do that within a cost structure of about $1,000 to $1,100 gold. And that's all in sustaining costs, which includes your operating costs plus your sustaining capital. So we believe that that is a cornerstone asset for us. If we are able to achieve that optimization and expansion, we believe it would make Magino one of the largest, lowest cost, and longest life gold mines in Canada. And we would be the only one not owned by Barrick, Newmont, or Agnico. So it's a unique opportunity to own a tier one asset in a tier one jurisdiction, not owned by a senior. So that's part of the proceeds. The balance of the proceeds will be used at Florida Canyon. At Florida Canyon, we've underinvested in that mine. And now over the course of the last year, we're changing that. So the proceeds will be used to finance a new heap leach pad, as well as increase flow rates to the leach pads to increase recovery rates, as well as continue with both our oxide and sulfide drill programs at that mine. And the goal is to create a larger, lower cost operation at Florida Canyon.
I hope we can touch upon Florida Canyon as well, but I do want to stay on Magino here for a second. What's sort of the timeline as well as the expected cost for two things? Number one, to get to nameplate capacity, and then two, to then potentially grow that capacity to that 20,000 TPD that you told me about.
Okay, so we're already at nameplate of 10,000 tons per day, and there is probably some scope to increase throughput through the current mill with some small modifications to the system. So that work and engineering work has begun. In addition, the work to expand the mill to somewhere between 17.5 and 20,000 tons per day has begun. And we would expect to have an updated feasibility study in the third quarter of next year, which include the updated drilling through probably the end of June or July of 2024, as well as the cost and the timing of the expansion to that higher rate. And ideally, we would move forward very quickly thereafter with that expansion. And the funding, the equity raise that we just completed, combined with the free cash flows we expect to generate from our existing operations, combined with a refinance of our current debt facility, should allow us to be able to move forward in an expedited fashion on that expansion.
Right. But the majority of that $80 million is going to be used for the Magino mine.
Probably half and half.
Okay. Right. Okay. And that's sort of the financial side of it all. But of course, the geology has to be on your side too. And we have seen, if I'm not mistaken, a decline in the grade at Magino relative to what you had previously expected. Well, it might have been before your time, actually, but what the company had expected. So do you think that based on what you've seen so far, the grades will allow for that 20K TPD to be an optimal rate of production, or is that something that is yet to be determined?
So in terms of grade, we consciously mine lower grades into the third quarter because we had the mill complete, the gravity circuit, which is required for the higher grade coarse gold, was not complete until midway through the third quarter. And unfortunately, it wasn't operating effectively. And we didn't make those changes to that circuit until around November the 1st. and now I'm pleased to report that it's operating as designed. That combined with we were behind in terms of our mining rates, and so we had to be a little bit, we had to design our ore block model a little bit larger, which meant lower grade, to allow us to make sure that we had sufficient ore ahead of the mill in order to meet the mill capacity. But we're pleased to report that that's behind us. And now with a sufficient stockpile sitting beside the mill, we can be more selective with our mining practices in line with the tech report. And we're seeing grades rise above reserve grade, which is 1.15 as we move through the fourth quarter. So we're quite confident that we'll be able to achieve both reserve grade and reserve tons as laid out in the reserve model, which was a very robust conservative model.
So what's the grade you're mining right now as we speak?
So the average grade that will be going through the mill post the redesign of the gravity circuit is somewhere between 1.2 and 1.4 grams per ton.
Okay. Right. And you expect that to remain the case even if or when you ramp it up to 20 instead of 10,000 TPD?
Hard to say because that work hasn't been done. What we've been saying publicly is, just to use a round number, at 20,000 tons per day, at reserve grade of 1.15 grams per ton, recovery rate of 92%, which is our stated recovery rate, that's 250,000 ounces of gold per year.
Mm-hmm. That's right. What happens to your operating costs in that case?
We would anticipate that operating costs, so that all-in sustaining cost per ounce, would be somewhere between $1,000 and $1,100 per ounce.
Does the increase in capacity coincide with an increase in G&A or any other expenses that are not directly calculated in the all-in sustaining cost, though?
All of the costs required for the expansion, really, when you look at the expansion, we currently have 400 employees on site. And so with expanded production, we probably increase that number to 500 to 525 employees. So on a per ton or a per ounce basis, our unit costs actually drop for our G&A, and it will provide some efficiencies for our mining cost per ton as well.
Right. Right. And that's a good point to raise, or a good topic actually to raise, because in one of your recent updates, you also talked about labor being a challenge, which is the case for a lot of businesses out there, not only mining, but especially mining. What's the plan now going forward for filling up those job openings basically at Magino? Because I assume you won't prefer to keep working with contractors, right?
That's correct. Contractors are quite expensive. So where we stand today is, as I mentioned earlier, budget employment is 400 employees, and we're at 361 today. And we expect another 20 employees to start before the end of the year. So we are getting close to full employment, but it does take some time. And you really want to make sure you get the right people with the right values and the right skill set. And that does take time.
Right. Where are those people coming from? Are they Ontario based? Or are they locals? Where are they coming from?
Largely Ontario, maybe 3 to 5% are from outside of the province. Currently, about 17% of our employees are First Nations. We'd like to see that number at about 25%, but the majority are within a 4-hour drive to the mine site.
Right. Okay. And so what do you use, by the way, to find people to work for? Like, is it a firm that you're working with? Is that something you do on your own in-house? How do you deal with it?
That's a great question. It's a variety of different channels. So we use Instagram, we use our own website, we use the normal um, uh, LinkedIn and other boards for employment. We do use specialists for certain types of roles. So it really is a combination. We've got our own recruiter internally as well. So um, again, it requires a significant focus, and HR and our employee engagement is the most important thing that we focus on within the company.
Right. Yeah. Well, those are things to talk about that I've come to realize actually recently by visiting some of the conferences and like Minds and Money. That's often a topic within the panels as to how do you deal with labor, because that's, in these interviews, oftentimes you would focus on the geology and then the financials when it's a producing company, so on and so forth. But finding the right people not always is as easy. And well, forgive me if this is trivial, but my wife and I own a brick and mortar business as well. It's a bakery, so it's nothing like a mine, of course, luckily for us. But when we're looking for personnel and we have hard time finding it, or it's taking too long to find it, or we need them quickly, we'd either lower the requirements or increase the pay, or both at times. Is that something that's in your potential toolbox as well? Like, is that something you could do?
Well, what I would say is prior to my arrival a year ago, the company needed to fill the seats, and so they did lower the requirements. But as we've moved through this year, we've actually upskilled about 15% of our workforce that weren't a correct fit.
Hmm.
So the group of us here at Argonaut today has worked together for a long time. And the most important thing for success of a company is having the right people in the right places. And it's all about values and it's about competencies. So we spend a lot of time on that. So no, we don't lower, the requirements, because we need the right people. And it's important for the culture and all the people that you work with that everybody's competent. They share the same values, which, are important to us. We live by those. We hire and fire based on our values, and that is a focus for us. So what we've done is, instead of hiring less qualified people, we brought in contractors at higher costs to ensure that we build out the team appropriately for the long term. We want to make sure that our operations are a place that good people have a choice where they go to work. We want them to choose us.
Hmm. That's well said. I'm happy you're mentioning the contractors, because in the meantime, that's what you're filling those job openings with. But then there was something about there being too many small injuries or something of those sorts was communicated not too long ago. What's going on exactly there? I don't even know how to ask this question, but talk to me more about working with those contractors. What are the challenges that you find besides the cost being higher?
You know, the challenges with contractors during construction or different aspects where they're short term is there can be less of a focus on safety than what we put our employees through, and that did lead to a fatality a year ago, which was truly unfortunate. As we move forward and build up Argonaut, the focus is on safety. We start every meeting with a safety discussion, and that demonstrates how important it is to us. We're hiring a number of people within our safety and training groups to ensure that all of our employees make it home, safely at the end of their shift. But our current safety performance at all of our operations is well below. It's better than industry standards, but we can always do better. And that's what our focus is.
Right. Okay. And that's the case at the Magino mine in Canada. Oh, by the way, just one more thing about the inventories. As I said, about $110 million was on your balance sheet at the end of Q3. Is that at the Magino mine, or is that just that's company wise, I suppose, but where's the bulk of it?
It's spread between all of our operations. So keep in mind that the majority of our operations are heap leach operations. So you've got an inventory of gold that's on the pad to be recovered. The inventory number has increased over the second half of the year as Magino has ramped up, but the majority of it is gold in circuit and supplies inventory for each of our operations. And it's largely split between all of the sites
Right.
pretty
Okay.
equally.
So what's the sort of the end sellable product out of that? What are you selling basically is what I'm asking you here.
Oh, that's a great question. We sell doré bars.
Hmm.
So for all of our sites, we actually produce that doré gold bar that everyone who visits a mine site and gets to hold one just giggles like a
Hmm.
school child. It's a special thing to be able to hold those gold bars
Hmm.
in the gold rooms.
I thought they get to take it home. I thought that was the thing of visiting in mine.
uh, um, yeah, they wish. We actually in the old days. So I used to work at Barrick Gold, and when you look at the shape of the bar when it's sitting down, it's literally impossible to pick up with one hand, even for the strongest individual. So I remember joking with people that if you could pick the gold bar up, you could take it home, but nobody could as we did the investor and analyst tours back in the day. They're
Hmm.
quite heavy. They're about 1,000 ounces.
Oh wow, that's a whole lot. I think the heaviest that I've lifted was a kilo of gold, and I was surprised because it's smaller than an iPhone and
Yeah.
it weighs a kilo. So it is heavy. It's a good point. So why I'm asking you this is because it's gonna so that the heap leach basically, how long does it take to convert it into a bar?
Generally speaking, 90 to 120 days. There is some material that comes out a little bit early and some that comes out a little bit later, depending on the composition of that ore that's on the pad.
Right. And so the $110 million in inventories that I'm looking at, they should be becoming cash flow in like about 3 weeks or something along those lines.
Uh, on average, maybe 45 days for
Mm.
the heap leach operations.
Okay.
And then some of the buildup in inventory in the second half of the year is ore in stockpile at Magino. Some of that's current, some of that's low grade that will be put through later in the mine life. So there are a number of different dates on when those different assets get monetized within the portfolio.
Right. Okay. Good. Well, it gives me a better idea of what exactly is happening at Magino right now. We might bring it up later on. Um, and the labor part is obviously an interesting one because it's been in the news a lot. But is that the case for your Nevada operations as well? Because you're now in growth mode there as well. So I assume you're going to need more people. So talk to me about that. Timeline, labor, just anything and everything that's happening there right now.
Well, Nevada, like Ontario, are two of the largest gold producing regions globally. And there's just a shortage of mining professionals. And so we do struggle with hiring at Florida Canyon, similar to Magino. So that remains a challenge. We are looking to add about 20 people to the workforce at Florida Canyon. So we currently have 250 people. The goal is to bring that number up to about 270. And we are focused on the drill program at Florida Canyon, which will continue through 2024. As well as I mentioned earlier, we're building the next leach pad, as well as permitting and increasing the flow rates on our leach pads to allow us to improve recovery rates.
Hmm.
So Nevada is a very desirable jurisdiction to operate in. It's very mining friendly, like Ontario is, and it's a great place to be investing and growing.
Hmm. You're also drilling there, if I'm not mistaken, because you're preparing a PEA. Is that right?
Well, we might. So where we stand is that Florida Canyon's been operating for 30 years, and historic production with what's left, it's about a 5 million ounce oxide deposit, and it's still growing. And below that is a sulfide system. And the sulfide system is really, oxide's been weathered, so you can heap leach it. The sulfides haven't been weathered, they're below the water table. So there's an additional step required to oxidize that rock, which makes it a little more expensive. So you need better grades. So our current program that we've got underway at Florida Canyon has two components. The first is looking to expand oxide reserves, and that program is going well. And the second is to test below the oxides, the sulfide system. And really, we know it's a large system because there has been some historic drilling, but the key is the grade. Can we get the grade sufficiently high enough that it makes sense for that additional processing step that's required to be able to produce that doré bar? So that work is underway. And if we are successful with that sulfide program, which we refer to as a proof of concept, we would then move forward into a PEA, so a preliminary economic assessment, where we would continue to drill. But in addition to that, we would leverage the historic metallurgical test work that was done on those sulfides, as you know, to carry that forward so that we can develop a concept of how we would process that material, as well as look at the permits that are required to bring that forward.
How much drilling is that going to take?
It depends. It might be 10 to 15 million dollars.
Hmm.
Might be sufficient. Maybe it's 10. It really is a function of how that proof of concept program bears out. And one of the things that I'd like to highlight to everyone is that we've hired Owen Nichols, and Owen is our new VP Exploration. He started in September, and he had previously worked for Equinox. And so he was, you know, the lead geologist behind the rethink of what Castle Mountain could look like. It's a project in California, not dissimilar to what we've got here, a small heap leach where Owen and the team rethought what it could look like and drilled out over 4 million ounces, and it's now one of Equinox's flagship operations. So he was behind that exploration team. But then also at Mesquite, another California project that Equinox owns, he basically re-envisioned that and added about 2 or 2.5 million ounces to the reserve and resource base. So he's an incredible exploration geologist for this type of mineralization, and we're looking for him to work his magic at Florida Canyon.
Nevada is generally a good place to operate in, but it's, as far as I understand it, it's not a cheap place to explore in. Do you know how much you're paying per meter down there? Because you said 10 to 15 million dollars. How many meters is that going to get you?
Boy, that's a great question. It is about a $4 million program that we ran at Florida Canyon. And so I think the cost was somewhere between $100 and $200 a meter, depending on whether it was RC or diamond. I would say that Canadians are much better at RC drilling and Americans are much better at RC drilling. But neither of the drill programs that we're running, to a certain degree, are infill. So they're they're low risk programs. And because of the infrastructure that we've got in place, because they're both operating mines, the exploration programs are not expensive overall for what you're getting.
Right. Okay. Why I'm bringing this up is because, well, you raised 80 million right now. You're financed to do all of that work. But how do you look at financing holistically, if you will, if that makes sense? As in, what is your strategy around financing? Is the target for you not to have to raise capital once Magino is at those 20,000 TPD, so at the potential that you hope to get now, or do you think you're still going to have to raise money? And then when it comes down to actually raising money, how do you expect to keep financing yourself? Is it going to be debt? Is it going to be more share issuance? Do you maybe think that some of the assets in Mexico could be sold to grow operations elsewhere? So yeah, I don't know if that makes sense, but how do you think about financing?
That's frankly a great question. So why don't I start off with your last point? So Mexico, as I mentioned earlier, has been the cornerstone of this company, but it does require capital to move those assets forward. And when we look at return on capital, it's the lowest return investments we can make. And so given the current debt we've got on the balance sheet for building Magino, it's not something that we can really move forward with. So we are looking for ways to monetize those assets. Our preference is to take equity, not cash, because we want the buyer, and the buyer's got to have similar values to us, because we want to make sure that our employees are treated well. But we want them to put the money in the ground to invest in these projects and extend these mine lives. So we'll take equity that will ultimately be monetized at some future date, but not something that will help our balance sheet today. This equity raise that we've just done will assist us as we look to refinance our current debt facility to better match our requirements as we look to invest in both Magino and Florida Canyon. So we believe we've got an internal estimate for the cost of the expansion of Magino, and we believe that this raise, combined with the free cash flows that we're generating from our operating assets, as well as a refinancing of the current debt facility, will allow us not to have to return to the equity markets to be able to execute and build out both mines.
You say not return, is that
no further equity dilution?
Right. Okay. But that's basically, I mean, the hopes are for that to be sort of a permanent statement, like never say never, I suppose, but potentially never return to the equity markets.
Well, we think longer term, because you are developing, 10, 20-year mine lives. So we think longer term. And we believe, assuming gold prices $1,900 or so, that, we will be in a position where we can build out and expand both Magino and Florida Canyon without returning to the equity markets.
Okay. What's a realistic potential timeline for getting the Mexican asset, monetizing the Mexican assets, basically? Let's not call it getting sold, but just to monetize them in any shape or form. What's a reasonable timeline?
Well, we've got a process underway. And so assuming that we find the right group, it could be Q1, the assets are sold, but it could be several years before we're able to monetize our interests in those assets, because we want to give the team that buys them the opportunity to invest and advance them. And we don't want to be a drag on their balance sheet either, or their share price. So we'll work with whoever buys the assets for the benefit of our Mexican employees.
And so whoever buys those assets, what does, again, that's the forward-looking statements that I talked at the beginning, but what does a potential deal look like? Do they get all four of the assets, or the three mines and one of the development projects, or is it sort of on a mine per mine basis that you're going to be looking for a partner?
Not clear. That we've had offers for both all assets and for individual assets. So it will ultimately depend on, in our view, what's the best group for each of those assets to be able to move them forward and retain and continue with employment.
And that 230,000 ounces that you told me about at the beginning, if we talk next year at the same time, and if you manage to monetize or manage to get those assets off your own balance sheet, how many ounces of those 230 are you going to keep if you don't have the Mexican assets?
So our guidance is the lower end of 230. So let's say it's, just to use round number, 205, and roughly 160 to 165,000 ounces will be produced by our Mexican and Nevada operations, the balance at Magino. So as we look at Mexico, it'll produce, call it, between 80 and 90,000 ounces this year. And so those ounces would be going away. But overall, we would expect our guidance for 2024 probably to be somewhat similar to our guidance for 23, being 2 to 230,000 gold equivalent ounces.
Do you think Magino will be cash flow positive by then?
Yes, it will generate free cash flow in 2024. Yes.
Okay, right. And so then, just strategically, if you will, company-wide, is that going to be then 100% of your focus, so Nevada and the Ontario operations, or do you expect to be active on the M&A front as well?
Another great question. The answer is, when we look at our current assets and the prospects for those assets, we're trading well below fair value. So our focus will be Magino and Florida Canyon to execute and move to fair value. And until you're at fair value, the board cannot consider whether they sell or buy other assets. And it'll be up to the board at that point. But we've just got our heads down for the time being, and we're focused on execution.
It's kind of challenging, right? Because when the markets are kind of depressed as they are right now, there's many great opportunities for M&A, but then at the same time, you also have to get the money somewhere, and capital is expensive in this environment. So it's a balance, I suppose.
Yeah, and great point. We look at per share value creation, not growth for growth's sake. So everything that we look at is through the eye of what is our per share number, and will it increase per share value? That is what we focus on as an organization, is per share growth. We have no desire to be the biggest. Our desire is to have the best share price performance over time. And that's what our goal is. And so maybe just to focus maybe on my last job, I worked for a West African producer, and that West African producer was the TSX, which, as you mentioned earlier, we're listed on. They produce a TSX 30, which are the 30 top performing stocks, any sector, over a 3-year period. And we were the 8th best performing stock over a 4-year period on the TSX. And we are hoping to replicate that here at Argonaut. I know it's been a tough year, and it was always going to be a messy year with the completion of construction and ramp up at Magino. But we believe that's behind us. And as we move forward, we believe we'll be able to execute and deliver strong shareholder performance as we move forward.
Well, I guess everybody hopes to do that. It's more about the how that's interesting. One tool in your toolbox here could also be share buybacks, because with the current raise, you're going to be what, over 1 billion shares, which is on the higher end for TSX companies. Is that something like is a rollback or even a share buyback program? Is that something that's even on the table potentially right now?
Not today. Today, the focus with this raise is to execute and build Magino into one of the largest, lowest cost and long life mines first, and then look at Florida Canyon and both the expansion of the oxides and the potential development of the sulfides. That is the best use of capital today. Now, there may be a point in the future when a share buyback or a rollback makes sense. But today, the best use of proceeds and free cash flow is growing those two assets into a low-cost mid-tier gold producer.
Right. Okay. That's clear. That gives me an idea of sort of, again, strategically. What if we focus on the other side of the M&A equation, though, as in being the target of M&A? You mentioned something about it there, that you have to get to fair value and then the board can think about it. And but so as you mentioned, you worked at Barrick for a while back in the 90s. What would it take, for example, like what does Argonaut have to look like for a Barrick-sized company, or one of your neighbors in Ontario, frankly, is surrounded by big companies there? What do you have to look like as a company for someone like that to come in with an above market offer that you think represents fair value?
Well, I think that as we move through next year and we complete that infill reserve development program at Magino and complete the feasibility study for the mill expansion, again, it's low risk. The project's now built. These are just low incremental dollars. And there's a pathway for Magino to be one of the largest, lowest cost and longest life mines. I think that clearly would put it on the radar for a variety of different companies. Now, whether it's the largest companies in the sector or a step down, I don't know. And then you look at Florida Canyon, and Florida Canyon, particularly if the sulfides work that we do is successful, might make a great fit for other mining companies that operate in Nevada, that have some of the infrastructure that would be required to process that gold. So I think that as we move forward and do our jobs, it will make Argonaut a more attractive company, both for investors, that will be reflected in a higher share price. But as we move forward, I believe that assets in Ontario and Nevada will trade at higher premiums and be more desirable than they have been in the past. And that there will be companies that would, like to acquire Argonaut. And whether or not the board deems that the appropriate path or not, it'll be up to the board to decide. Our job as management is to execute, create that value, and move our share price to fair value, which it's not today.
What would fair value be? Like, what is that more specifically, in your opinion?
It's a number that is well above the target prices of analysts today on the street, which is roughly $1 Canadian. It would be a multiple of that.
Right.
In my mind.
It was also notable, by the way, as I mentioned at the beginning, is that the convertible debt that you have is at what, 268?
It's 286 US.
86,
so
right.
Roughly $4 Canadian.
Okay, $4 Canadian. Yeah, so we'll talk to me about that. I mean, it's rather high, so I don't suppose it's going to be converted, or could it be, or like, how do you think about that?
Well, we would seek to buy it back and not allow for the conversion because, again, our share price, depending on gold, may or may not be above that $4 level. But we wouldn't want to suffer that dilution because as that comes due in 2025, we should be daylighting a much higher production rate and free cash flow rate. So your point earlier, we would want to use our cash to buy that back and not dilute our existing shareholders.
Okay, fair point. That was sort of a side note here that I was wondering about. But to go back to that fair value, how does a major look at fair value? Like again, you having worked at Barrick, how do they value? Is it a dollar amount per ounce in the ground? Is it production? Is it free cash flow that they're valuing? What do they value?
So I think acquirer looks at it on many levels. You know, generally speaking, the accretion to the key metrics, production, cost profile, earnings, cash flow, free cash flow. So they'll look at the existing operation, then they will embed, target company and see whether or not it's accretive or dilutive. And generally speaking, what you end up finding is that the larger companies that are more diversified trade at much higher valuations than smaller companies. So, there's a natural accretion. That's one element that they will look at. Second is the nature of the operations, the location, the mine life, the cost structure, and how it might improve their current portfolio and how it fits within their current portfolio.
That's maybe an important point when it comes down to thinking about who might step in. And given that you have assets in two different jurisdictions, do you think both of those assets fit within one portfolio among the companies that we see being able or having the ability to potentially again acquire you? Is that one company, or do you think it would make more sense for those assets to be split and sold separately?
It's a great question. They're both tier one jurisdictions. And I think all mining companies seek more assets in tier one jurisdictions. But they are similar, but they're different. Don't know. I mean, there have been times where two companies have jointly bid for another company where they split the assets. Hard to say. Our focus today is delivering, but 2 years from now, you will have two very well-run operations with very good management groups that should make it easy from a corporate perspective to operate and own.
To operate and own, I can see that. But I'm also thinking about, again, forward looking, so a potential deal up in the future, how that might work in terms of the corporate structure, because you have, what did I say, 3 shareholders own 43% of the company. What is GMT at, if you can remind me again?
Just under 30%. And
Right.
Libra is roughly 10. And then we've got Franco-Nevada.
Right. And so I'm thinking, like you would all have to be on the same page for this like everybody would have to be on the same page for this to happen. Is that doable? How's that internal relationship with GMT?
It's very strong. GMT is a cornerstone investor. They believe in the vision that management has articulated with respect to both Magino and Florida Canyon. They have offered and would have put more money into this raise, but were limited to their pro rata share, but they certainly would have been comfortable putting more money in. So they believe in the opportunity. And I think that the board and our shareholders are aligned, and the goal is to create shareholder value. And as I mentioned earlier, we focus on per share value. And so I think the board and our major shareholders are aligned.
Hmm. Maybe we can talk about that as well. I do realize that you almost have to go here, but you mentioned that a few times on a per share value, and that's something new, if you will, within maybe not within the strategy of the company, but within the communication strategy of the company since you came in, right? The
Mhm.
the per share value thing. Talk to me more specifically about what that exactly means and how do you get it?
Well, any public company, we're here and we work for our shareholders and the goal, and we take it very personally, that our goal is to create value and make money for our shareholders. And the way we do that is by allocating capital to the highest return projects and growing this business. And our management group that I work with has been there, done it before, and we'll do it again here at Argonaut.
Does that also include something that we didn't really talk about? We have two greenfield assets. Well, not let's not call it greenfield. Let's just call it early stage exploration assets in Canada
Mhm.
as well. Obviously, not a focus. But what happens to those assets within that strategy that you just told me about?
They don't feature a prominent role within that strategy. Uh, we've got higher return opportunities at Magino and Florida Canyon to invest in. There just isn't the capital available for lower return, earlier stage exploration projects at this point in time.
Mhm. What would it take for me? Like if I call you up tomorrow and I say, Richard, I want to be a CEO of my own company. I need an asset. Can I get one of those assets? What would it take for you to make a deal with me or to even entertain my request for a meeting?
Well, we would talk to anybody. And again, we look at what's best for our shareholders, and we would look at the value of the asset, both in our hands and in others' hands. And if, if there's an opportunity to move things forward and create jobs and value, we would certainly look at it. Like I said earlier, our hands are full with Magino and Florida Canyon.
Hmm.
We think those two assets potentially could build a very strong, low-cost mid-tier gold producer on their own.
Hmm.
We've got limited capital, and we want to allocate capital to the highest return projects. So we've got to be laser focused.
Right. And but that's right. And on the Magino asset, for example, there's already a royalty on. Do you think there's room for more royalties on it and or a royalty on the other asset, or just generally, how do you think about royalties?
I've worked with Franco-Nevada my entire life, actually. They've had royalty or been part of every company that I've worked for. They are a terrific investor, and we're welcome to have them on board. But, as we look today, I think that we're in a good place in terms of our capital structure, and we don't anticipate looking at further royalties on our properties. We are looking at a refinancing, and there may be something attached to that, but that'll be part of a broader refinance package. And we'll look at that through the lens of what is most shareholder friendly and gives us an ability to execute on our vision as we've laid out.
Right. Okay. Well, I think it's clear enough. You're focusing on Magino, focusing on Florida Canyon, where you're looking for growth. One side is where you want to grow the mill capacity, basically, and the other one you're looking for um, to grow the life of mine, basically. The Mexican assets are no longer the focus. You're potentially looking to monetize them. It's making sense here. What is something that you came here hoping to talk about, but I'm failing to bring up?
I think you've done a thorough job with the interview. I think we've covered off all of our key messages and our focus. You certainly did your homework and were well prepared, and I appreciate that. So thank you, but I think we've covered everything off.
Okay. Well, thank you so much, Richard, for investing in time. I mean, I hope we can do this again. sometime soon when you have an operational update. And yeah, thank you so much for doing this.
Would love to. Take care.